Sen is with us, energy analyst, ICICI Securities. Probal, good morning. Good to have you with us here. We had the GE Shipping Management with us, and it was not so much about a conversation about. It was basically about tanker rates, etc. I don't know if you heard it day before yesterday. But we asked the management of GE Shipping what happens to product cracks, etc. And he said, well, they're exceptionally high. Diesel cracks $30-40, and you can see a substantial fall if the war in Ukraine ends. Your thoughts, Probal, first up there.
No, absolutely. I think one of the critical issues has been the attacks of Ukraine on Russia's energy infrastructure in the last couple of months. If you look at the kind of refinery capacities that have gone offline, according to, I think, data from certain industry trackers, the overall global refining industry offline was somewhere around 5.5 million barrels a day in August. That number went up to somewhere around 8.5 million barrels of oil per day in September, October. So obviously that has created a lot of supply tightness in specific products, and that's where diesel margins have really taken off. Having said that, what we've really seen is that in the last couple of weeks, there has been some normalization. At least data that we have suggests that diesel spreads are back to about $25, $26 from highs of $40 that they hit at the beginning of the month. So there is some normalization that's happening. If there is obviously a ceasefire or any sort of conflict resolution, which allows Russia to rapidly rebuild or, sort of repair its energy infrastructure and bring those capacities back online, you can probably see a little bit more softening that can happen and some normalization of those spreads.
Probal, hi. And I was reading a note from one of your peer brokers, and that seems to suggest that on the marketing side, margins have been coming off quite a bit for these three entities. And I'm not sure what's led to it and whether it's a one-off. So let's address that. Let's just see, get your sense on how you expect the refining margins to be, whether they can, these high levels, whether they'll sustain. And then a word on the cool-off in marketing margins. And then we'll come to the overall picture in terms of what it means for OMCs.
So the way you've got to look at OMCs is to look at integrated margins at the end of the day. What has happened is that absolute prices of diesel and petrol, obviously, given that spreads have expanded, the absolute prices have obviously risen up quite sharply. That reflects partly in GRMs, but GRMs is essentially about just the spreads. But given that crude hasn't moved beyond a certain range, the absolute prices themselves have gone up. And retail fuel prices have remained unchanged. So retail margins collapsing or reducing is not that much of a surprise. That's just arithmetic. Having said that, as you rightly pointed out, GRMs, if you look at theoretical GRMs on a QOQ basis, our sense is that GRMs have probably gone up by around $3.5 to $4 for all downstream players at this point of time in this quarter. So even though blended retail margins and admittedly diesel is at close to negative levels, but petrol has still held on at about 6 to 7 rupees. So blended retail margins are down about 3.5 to 4 rupees a litre. The balance between these two still means that integrated margins are probably down maybe about 1 rupee a litre at best, against maybe close to 7 rupees that they did on an average. I'm talking about the three OMCs in Q2. To somewhere between 5.5 to 6.5 rupees in Q3 as of now. So the issue really is that as long as integrated margins continue to remain, fairly robust, just a reduction in retail margins is not something that, will worry us. This can easily, as I just mentioned, given that diesel spreads have started to normalize, absolute product prices can decline, and that can once again bring retail margins back to at least some semblance of normality.
So as of now, you're saying that integrated margins have not dipped too much, barely a rupee or so, give or take. So then from a stock perspective, not talking about stock prices, from what you say, then stock prices don't seem to be at any risk of a sell-off. I mean, overall this year, calendar year, I think between which stock you're picking, the stock price is up 15-20%. So short point, what should we do with OMC stocks?
No, I think we would continue to be positive. We really think that, at the end of the day, as I said, either, the GRMs continue to stay at these strong levels, which we believe is probably, a bit optimistic to think. I think there would be some normalization in terms of product spreads, but there is still supply tightness. There is still a lot of capacity offline that will take its own time to come back into the markets. So some tightness will remain. And at the same time, if crude continues to basically soften and if news continues to, come through the off-conflict resolution, specifically in Russia, Ukraine, with the kind of supply surplus that's already there. If crude actually softens, then the absolute product prices will also sort of really come off, and that can support retail prices as well. So our sense really is that consensus earnings or our base case earnings are not really at a huge risk. Yes, there can always be a downside of 5 to 7%, but even after the rally that the downstream names have seen, the fact is that valuations still remain at fairly comfortable levels. Add to that the LPG loss compensation, the reduction in absolute LPG losses for this year against the 400 billion expect to have just about 150 billion of loss in this year. And I think those two factors combined means that marketing earnings can still hold on slightly better than what the pessimistic outlook would be. We would remain fairly positive at this point of time.
Okay, so you're positive on all the OMCs. Not sure if you have a coverage on Chennai Petro, maybe throw in a word there. And Reliance, particularly now that Reliance has stopped buying this Russian crude, and apparently the discount has become as large as $6 to the barrel, just because Indians are not buying. Now, what happens to Reliance? And I'm talking, just the refining business.
As I said, as we have stated earlier, I think on your channel as well, that, if you do the math, even at 40% of crude, which was estimated at coming from Russia into Reliance's portfolio, and I have no way of knowing if that number is true, I'm just making a guess. But even at that level, if the discount earlier was at maybe about $2.5 to $3, you had basically an effective impact of around $1 or so in terms of GRM. Against that, the base margins itself are now up around $3.5, $4 plus, if not more. So, frankly, at least in Q3 and Q4 earnings, even without Russian crude, you're likely to actually show an increment QOQ in terms of your OTC segment earnings. So our sense would clearly be that against the 15,000 crore run rate that they showed every quarter in the first half, second half earnings are still going to be, materially higher if these trends holds, irrespective of whether Russian crude is coming through or not.
Okay, and of course, standalone refiners, will be the worst hit, right? Probal, as we saw in Chennai. But they've also had massive runs this year.
Again, it's a question of crude cost hit versus the absolute product spreads in terms of how they line up. We don't really cover CPCL and MRPL specifically, but theoretically the same argument holds in terms of where the margins are versus what the crude cost is.
So one name is if you had to buy in oil marketing, what is the top idea from here? Where there's downside.
We would still look at HPCL at this point of time. I think their refining to marketing mix is improving all the time. That provides a natural hedge against volatilities between the two margins.
Okay.
I think they will add a significant amount of decent petrochemical capacity. Leverage is going to continue to go down. And, marketing losses from LPG are also something that are not really a factor at this point of time. Okay. So we would keep looking at that name.
All right, got it, Probal. Thanks very much. That is very nicely explained on why Probal is not too worried about this fall in marketing margins and how the spreads are moving up from here on. He's still quite optimistic. Doesn't see at a blended margin level basis, he doesn't see more than a 1 rupee hit, if at all, on some of these OMCs.